Welcome, everyone. My name is Debidan Osikita. I'm the founder of Stock Pickers Academy. This presentation is basically just going to give you an introduction to stocks investing from within the UK. I always like to start with this quote: investing is for everyone. Investing is not a game where the person with the highest IQ makes more than the person with the lowest IQ. That's Warren Buffett. Before I go further, just to introduce myself a bit more and tell you a bit more about my background. I grew up in Peckham. I studied maths at uni, and I started my career as a trader at Goldman Sachs, the biggest investment bank in the world. I traded stocks there, and trading stocks and in an investment bank requires you to understand Forex. It requires you to understand interest rates. It requires you to understand some commodities, treasury, and a load of other things as well. I spent a few years there before moving to a Jewish family office to trade multiple other asset classes before moving back into the investment banking world at Barclays to work in money markets, which is basically managing the cash of the firm, the treasury of the bank. So it's still trading, but you're trading loans, you're trading bonds, and you're doing transactions with different central banks like the Bank of England. And then I spent 3 years in the Channel Islands in Guernsey, where I was working in a quantitative hedge fund. And what they do is they build algos, they use AI, and they build mathematical models that will trade the markets through algorithms. That was a very, very interesting 3 years. And it's combining all those different ways of making money, all those different institutions, that I was able to come up with my own strategy in which I now teach people how to long-term invest in the stock market. And I use the word long-term because investing is different to day trading. You might have heard about day trading. Day trading, the aim there is to actually make an income each month, of which you might take a portion of that income to save. And then when you're looking at long-term investing, you're looking at your savings, and then you're taking maybe 50-40% of those savings, and then you are investing it in, whether that's buying property, whether that's buying some stocks, whether it's a combination of the two, whether that's buying some crypto. But that investing capital is then what you come to an investing coach like myself, and we figure out what the best things to do with that capital are, and make sure that you have the right strategies to apply it. So I'm going to assume everyone is starting from zero. I know some of you might have done some investments in the past in stocks or crypto, but let's start from ground zero. So I want you to understand some key investing terms, how to choose an investing platform, taxes and the types of account, the basics around strategy, and then I'll show you a little bit about my course and investing groups and compare that with self-learning. Here are some key facts. So less than 7% of people in the entire UK have what is called a stocks and shares ISA. A stocks and shares ISA is basically a type of account that enables you to buy stocks, just like having a bank account. If your bank account, Barclays, NatWest, Nationwide, allowed you to buy stocks, then that would be a stocks investing account. An ISA is a special type of stocks investing account that makes sure that you do not pay any taxes on any profit that you make. So the government has put this initiative in place. And why do they do that? Because if individuals like yourself, like myself, invest in companies in the UK, it helps those companies to do well. It helps those businesses to do well. And ultimately, it helps the UK economy. So the government is incentivized to facilitate that as best as possible. So they give us these stocks and shares ISA accounts where we do not pay taxes on any profits we make. I'll go into it a bit more later on, but the maximum you can actually put into any stocks and shares ISA in terms of cash is £20,000 each tax year. So if you're sitting on £100,000, you can't just load that into a stocks and shares ISA. It will take you 5 years to deploy that capital into a stocks and shares ISA. But if that grows to 1 million, 2 million, 3 million, you can sell at any time, tax-free. And it's important to note that just because you put money into a stocks and shares ISA doesn't mean that it's invested in stocks and shares. On a very basic level, a stock is a company, is a business. So when you buy shares in a business, you're owning a small percentage of that business. And that's what you're doing when you are buying shares. You're buying a share of a stock. A stock is a company. The two words are interchangeable. Ownership. Of the 7% of people that even have that type of investing account in the UK, this is an appalling number, by the way, and you'll see why as we go through the presentation. Only 43% are held by women. So women historically, currently, just do not invest that much in the stock market. Problem with financial literacy, which is why I'm here today, to answer your questions and to give you an insight. But another random fact is 80% of my clients are women, Black women. So we're seeing a lot of change. Transfers from cash ISAs. So a cash ISA is basically a type of account where it's just like a high interest savings account. 1 second. Transfers from cash ISAs to stocks and shares ISAs jumped 30% at Hargreaves Lansdown. Hargreaves Lansdown is a type of platform. And I'll get into that later on as well. But the same way you can go to Tesco's, to Morrison's, to Waitrose, is the same way you can go to Hargreaves Lansdown or Vanguard or IG Index. They're just providers of these stocks and shares ISAs, as well as other things. The average return was about 7% in the stocks and shares ISA, investing in stocks, versus 0.5% on a cash ISA. So here's some key investing terms. Taxes, we all know what those are. Crypto, we're not going to go too much into that today, but it's a way to invest in blockchain technology through lots of different types of coins and tokens. I would definitely urge you all to start at least learning the basics of crypto. And I do educate on that as well in the group. The technology is here to stay. And there are a lot of myths around crypto, which if you know, you know. In the group, we dispel. But yeah, there's risky stocks and there are safe stocks. There's risky crypto and there's safe crypto as well. It's all about having a good strategy. Index funds, not going to get into that yet. Compound interest, I'm not going to get into that yet. That's what I'm going to do last. ETFs. An ETF it stands for exchange traded fund. It is a way to invest in a ready-made portfolio of stocks. So without needing to pick stocks individually, you can invest in a theme like robotics. And if you buy a robotics ETF, what you're doing is you're buying a ready-made portfolio of maybe 100, 200, 300 different robotic stocks from around the world in tiny little proportions. An index fund is a bit similar, but at country level. Inflation. If you are hoarding cash, honestly, that cash is being eroded and you won't notice. If you have £100,000 in the bank or £10,000 in the bank and inflation is 10%, because things outside are getting more expensive at a faster and faster rate, the reality is what you can buy with that £10,000 today, you would need £11,000 to buy exactly the same items next year if inflation stayed at 10%. In other words, the purchasing power of your savings is dropping. Don't leave cash under the bed. The way governments fight inflation is by increasing interest rates. That's something to know. REITs, real estate investment trusts. Again, we're not going to get into too much. All you need to know today is that you can buy commercial property. You can own a share of commercial property through the stock market. The company that owns Westfields, that all the shops pay rent to, is listed on the stock exchange. And you can literally £5, £10, you can own a little bit of that. And they will pay you a percentage of the rent and call it a dividend. So you don't need a lot of money to invest in property. You just need to understand that there are other ways to invest in property, like the stock market, and REITs are your way to do that. And I'll show you an example of that later. Before I get onto index funds, I'm going to go through compound interest. So follow me on this. Some of you would have heard this term before and will get the basics of it, but maybe have never actually gone through the calculations and seen the numbers. So I like to start with £5,000. We're in the UK, so I try and stay away from dollars. Let's say you had £5,000 and you put it in your bank and your bank was paying you 10%. In 1 year, 10% of 5,000 is 500. So in 1 year, your £5,000 will be worth 5,500. £10% of £5,000 is 500. And then, 1 second. The second year, so here you have it on the right here. £5,000. If you made 10% in the first year, that's £500. Now you're starting the second year with 5,500. If you earn another 10%, you will get paid £550. And when you add that on to your 5,500, you're on 6,050. So what's happening here is because you're not taking your money out of the high interest savings account, it's growing itself without you needing to do anything more. And after 5 years at a 10% rate, your £5,000 is worth £8,000. This process continues. Money is making money, i.e., money is compounding. Hold that thought, because the next big question is, how do you achieve 10%? And we're going to go on to that. But before we go on to that, I want to show you a few more scenarios if we can achieve 10%. So, how long is a mortgage? 25 to 30 years? I'm going to go 25 years. Now we're going to do a comparison. If you can achieve 10%, whether that's through the stock market, whether that's through crypto, whether that's through a high interest savings account that's just paying you 10% each year, if you can achieve 10% return on investment each year for 25 years, I'm going to hit calculate. In 25 years, your money would have grown to about £55,000, 10x in 25 years. How about if you added a monthly deposit of £100? And again, £5,000 at the beginning and £100 a month. 100 times 12 is 1,200, which means you would have roughly 6,200 anyway in cash. But obviously, you're getting paid 10% interest on that as well. Look at that. £5,000 and £100 a month for 25 years. If you can achieve 10%, will give you about 180,000. A lot of us could have been wealthy if this knowledge was just there. And you'll see why later on. Right, we started with £5,000. How about if we started with house deposit money? Let's call it 25,000. 25 years, 25,000, no deposits, 10%, 270k. How much do people spend on their mortgage? Anything between 1,000 and 2,000. That's fair. So let's say we will even just take the low end, £1,000 a month and £25,000 to begin with. And if you're able to do that for 25 years at an interest rate of 10%, you're a millionaire. Of course, you could do that in a mortgage and buy the house, and the house triples in value as well. But you'll pay tax. You will pay tax on your profits. And when you calculate the length of time, usually on property, real estate will average you about 6%, 5 to 6%. So if you can achieve 10%, that's even better. And it's not to compare and say you should do one or the other. It's more to say, have the financial literacy so you can make an informed choice. It's better to have the education on both, and it's then up to you which one you want to deploy at what time and how you want to mix it up. Now, when we come to picking individual stocks, the return is different to when you're trying to just invest in a ready-made portfolio. So we try to go for 20% minimum. And to put things in perspective, in 2020, when the market was really good, my clients were averaging about 120% return, not 20%, 120% return, which was way above the target of 20%. But markets get like that every decade. Once every decade, you get markets like that. However, what do the numbers look like? £25,000, 20% interest rate, £1,000 a month. Big. So when we talk about the wealthy getting wealthier, it's because they understand compound interest and they figured out a way to get 5, 10, 20%. Okay, if this number was £5,000 and you're achieving 20% and you're putting £100 a month, you can still become a millionaire. You can still become a millionaire after 25 years, starting with 5K and putting £100 a month. This is the power of compound interest. But the key deciding factor really is the interest rate you can achieve annually. But what if I told you there was a way to guarantee about 10%? Roughly. There's one way that I know of that I can say, do you know what? You'll average roughly 8 to 10%. Guaranteed. That's investing in something called the S&P 500. S&P 500. You can type that into Google. It will show you the price. You can hit max and you can see that this thing just goes up. Yes, it has some dips along the way, but right now it's at a record high. The highest it's ever been in history yesterday. Despite the fact that inflation is high, despite the fact that we're in a cost of living crisis, despite the fact that the world is not in a great place right now, this is hitting a historical high. The highest it's ever been in history. Why? Because companies will keep making revenue. And if I tell you what this is, it's the biggest 500 companies in America. It's a ready-made portfolio consisting of the biggest 500 stocks in America. Bear in mind, they're probably like 20,000 stocks in America, maybe even more. But this is just the biggest 500. Created, it's the most important index in the world. An index is a collection of stocks. This particular collection of stocks is the criteria is the biggest 500 in America. America is the leader of the free world. So you can see how this is a very powerful index. And history has shown that for the past 150 years, 150 years, this data is not even up to date. Like they say 66 years, but I know that that's just the construction of this index here. But in terms of the companies in these indexes, in this index, if you look at the prices over the past 100 years, 150 years, if you take that price there at the top and the price in 1900, it will average about 10% a year. The average is about 10% a year. And based on that, that is a lot of time for us to have a reasonable enough measure to say, do you know what? Investing in this is the only way to guarantee a profit of 10%, a return of 10% in the long run. So when we do this calculation here, what we're basically saying is if you invest in the S&P 500 passively, by the way, this is passive investing. You do not need to keep looking at your screen. You don't need to open your your investing account, your stocks and shares ISA every day. You can literally set this up as automatic direct debits of £100 a month. Start with an initial of any amount. It can take you 4 years to save up 5K. It may take you a week, depending on your financial situation. So you don't need to start with 5K. All it does is maybe it takes another 3 years. So your 25 years looks more like 30 years, but it doesn't matter. The bottom line is you can passively invest debit and achieve about 10%. In fact, let me throw you a fact. If you did this for the past Hello? Oh, did you lose me for a second? Okay. How long ago? Just a minute ago. All right. So if you start with £5,000, the point I made was over the past 10 years, the number is not even 10%. You would have averaged 14% in the S&P 500 over the past 10 years. Last year alone, you would have made 25% just last year alone. So some years it will be 25%, 30%. Other years it will be zero. Some years it will be down. But the average will, over the past 10 years is 14%. So £5,000 for 10 years at 14% with £100 a month, your £5,000 right now will be 40K. 40K. That's 10 years. If your child was born 10 years ago and you put £5,000 in the stocks and shares ISA in the S&P 500, you closed your eyes and you just set up £100 a month, your 10-year-old will have 40K to their name. That's what the data is showing us. Now, if you're picking stocks and you were able to achieve 20%, 65K. There's an extra you make. But you don't even need to pick stocks. Even passively, over the past 10 years, that's what you would have done. But in general, it's 10%. If that's all you take away from today's session, fantastic. In reality, it doesn't really matter too much which platform you use. What matters is you're doing this. That's why I'm spending a lot of time on this section. This is the bit that matters the most. The platform, that's just a means to an end, right? You can shop in Tesco or you can shop in Morrison's or Sainsbury's or Waitrose. As long as you get fed. But we'll get into that. Index funds. Recap. So index funds, by the way, if you have questions, ask them and I'm going to answer them at the end. Index funds make investing financially accessible to the masses because they're designed to be passive, hands-free. So they don't require much attention. This results in automatic diversification, which minimizes your overall risk. A basket of stocks that represent a broad market. In the case of the S&P 500, you're buying a small piece of the 500 largest publicly traded US companies. Just like I said, the average annual return of the S&P 500 is 10%. Imagine comparing a stock to a fruit, like an apple or an orange or a pear or a banana or a pineapple. Then an index is a bit like a fruit salad or a smoothie. You don't need to buy the smoothie maker and buy the individual fruits and try and create your... You can literally just go into Waitrose and buy the smoothie. Right? That's what the S&P 500 is for stocks. An ETF is a way of buying the S&P 500 on a stock exchange. And a stock exchange is a bit like eBay. It's like an online shop you can go to buy stocks or to buy the S&P 500. Exchange traded fund. Historically, you couldn't do that. Historically, if you wanted to buy the S&P 500, you had to pay a fund manager. And the fund manager's job would be to actually go out and buy the 500 stocks on your behalf in the right weightings and composition to replicate the S&P 500. And that's a lot of work. So you'd also have to pay a management fee just for him to recreate the index for you with your £1,000 or £10,000. And often they used to have a minimum amount. So there was a barrier to entry. So now you don't need them anymore. You don't need mutual funds, as they're called, anymore. You can literally use an ETF for the S&P 500. So you look for the S&P 500 ETF. Another thing I'm going to mention is dividends. So there are two ways in which you can make money in stocks. If the share price goes up because the business is doing well, or if the company decides to pay out what's known as a dividend, which is, so a dividend is basically a imagine you've got a lot of savings, or a company has a lot of cash reserves to keep investors, because if the share price goes up, a lot of investors might want to sell and take profit. So to give them an extra incentive to stay, they will offer a dividend. Meta did that this year. For the very first time, they decided to start paying their investors a dividend. The share price has gone up so much, and I'll show you the chart for it later, that they needed to incentivize investors to stay in the stock. So they offered a dividend. Not a big one. I think it's like 1%, but that's an extra percent return that investors didn't even know that they were going to get. In reality, the stock price has actually quadrupled in price. So 400%. And now they'll make 401%. So in the grand scheme of things, the dividend is not that much compared to the rise in price, but psychologically, some investors will stay. FTSE 100 is the same concept, but in the UK. So the biggest 100 companies in the UK. What's the catch? You don't average 10% with the FTSE 100. You average about 6%, which is much lower. So it's not that attractive to American investors or the global investing community. And as such, it's a slower index, doesn't have as much attention, but it will still guarantee you 5 to 6%. So it's often a way to diversify the portfolio. And what some investors do is they use some chart analysis to try and get it on the dips. Vanguard. Some of you would have heard about Vanguard. Now, it can be a little bit confusing. Vanguard is actually a manufacturer of index funds. They're a company that create these indices. But Vanguard is also a platform. It's a bit like buying Tesco products from Tesco or buying Nike trainers from Nike. You can also buy Nike trainers from JD Sports or Sports Direct. So Vanguard is like a Nike. It creates the trainers, the index funds, but it also has its own shop, its own investing platform for index funds. But on its platform, it won't have many individual stocks to buy. So it's actually not the best platform, but it's very well regarded in terms of the index funds that it has. So we'll talk platforms after we talk about account types. Cash ISA, we covered that. It's like a glorified high interest savings account. You can't buy stocks in it. A lifetime ISA is very interesting because the government will pay you 25% for every £1,000 you invest or you save. It's a savings account that will pay you 25%, but the maximum is £4,000, where it will then pay you 25%, which is an extra £1,000 per tax year. So if you put 4K in every tax year, you'll earn another £1,000. And there are penalties for withdrawing. And people could use this if they're trying to buy a house. Stocks and shares ISA, we've covered that. There's something called a junior stocks and shares ISA, which is the same concept, but for children. The maximum you can pay into it each year is £11,000. However, and they can't touch that money till 18, which is good, because if you've got relatives that want to give your child money into the ISA, they know that you can't touch it as a parent. So that trust is there. You have to be careful with the junior stocks and shares ISA as well, because for that reason, you don't want to put so much into an ISA and then you can't take it out, because as a parent, you find yourself in a financial situation where you need cash. So an alternative is to just open a stocks and shares ISA for yourself and pass on whatever amount you want when your child reaches 18 for them to open their own stocks and shares ISA. So there are different workarounds. A SIP is a self-invested pension plan. You can consolidate your pensions from old workplaces into a private pension and then use that private pension to buy index funds and individual stocks. I do that myself and I mentor people to do that. Spread betting CFD account, that's day trading. We're not going to talk about that. Premium bonds, I'm going to show you that in a second. They're a fun way to save with the chance to win tax-free prizes each month. The minimum you can pay in is £25. The maximum you can pay in is £50,000. You don't pay taxes on your winnings, but you can win up to £1 million. Very rare, but you can win up to £1 million. On average, people will get about 1% return on money that they leave in premium bonds. So when you do finally get a payout of £50 or £1,000 or whatever it is, it usually works out to about 1% of how much you have in the account. So that's the downside. But again, it's better than leaving money in the bank. Platforms. How do you choose an investing platform? I've listed 9. Trading 212 is the most popular. I use Hargreaves Lansdown because I just got used to it, and it's got more history. It's been around for longer. It's a stock that's traded on it's listed on the stock market itself. Trading 212 is a private company. Revolut, I would say avoid it. Free Trade, avoid it. These are bad platforms. And they try and entice you saying that commissions are free. Revolut, I see what they're trying to do, but if you've got Trading 212, you should never use Revolut, because Trading 212 is just better. The two things that matter the most when choosing an investing platform are how many stocks and ETFs it has. If you look here, you can see Hargreaves Lansdown has the most, 8,000 stocks, 1,000 ETFs. It would have changed because sometimes they do updates. But yes, you don't ever want to try and buy a stock and realize it's not on the platform. So availability of stocks is a big thing. The second big thing is you don't want to buy a stock and then it's stuck on pending. So it takes you a long time for the actual execution of the buy to happen. You buy a stock and it only confirms you 3 hours later. You don't want that. That's what's known as pending orders. And you can see free trade and Revolut. Typical. You'll buy a trade at 9 a.m. in the morning, and free trade will give you a fill at 4:30 p.m. when the market's moved. Diabolical. Avoid, avoid, avoid. The Giro is actually okay. It even has more countries than Hargreaves Lansdown, available markets. But yeah, trading 212, Hargreaves Lansdown, and the Giro are better than the other two by far. But pick one. You can only open one type of stocks and shares ISA each tax year. You can't open a stocks and shares ISA and trade in 212 and then open another one in Hargreaves Lansdown in the same tax year. So be careful. Commercial awareness. This is like, it's important to know the world we live in from an investing point of view. And my favorite app is Finimize, because what they do is they explain things to you that happen in the world. So today we had some big news come out that we entered a recession. It's good. It's great that we're having this this talk today. So we've entered a recession. Finimize will explain to you what a recession is, why it's important, what it means for markets. So that's commercial awareness linked with investing. So it's the best alternative to reading the Financial Times, archaic newspapers. It does it in bite-sized fashion. So it does it in a language that you can explain to even a 10-year-old. In small chunks, 3-minute audios and so on and so forth. So I definitely recommend the app. It's £40 a year. Finimize are one of my partners, so I can speak very highly of them. I know when they started over 10 years ago, and I've watched them grow, and I can vouch for them. So if you want the discount code, you have to message me on Instagram. I'll give you my details at the end. Twitter, great for news. You can literally type in a stock in Twitter and you'll see all kinds of news on it. So it's great for news. Follow financial influencers on social media. They often have some good insights. Most of them are in my group anyway. And we always share information and get into conversation, which is great. TV, CNBC, Bloomberg can be a bit jarring, but it's still a good source. And yeah, watch out for my stories on Instagram, because I do post other interesting news on there and other financial influencers that you can discover. I've covered some of this already, like the LISA and the stocks and shares ISA, 20K per tax year. Only one type of ISA can be opened each year. I'm going to talk about day trading. The truth about day trading is investors are split into two: high net worth or sophisticated investors, and then retail. To put a trade on, this is Coco, which I was doing some time ago, but to put a same trade in Coco in my account, I only needed £13,000 as a sophisticated investor. For someone else, if you were to open exactly the same account and try and buy Coco, you would need 50 grand, which makes it very difficult for you to manage that risk. And a lot of people don't know this, which is why I don't teach day trading, and which is why, unless you have the same account as me, it doesn't make sense. I can trade full time. Now, day trading is to get an income. That's my full-time job. Investing is different. It's taking your savings and saying, how can I grow my savings? Not how can I get money for Ghana in December. It's very important because your mindset is so important. Don't come with a fast, quick money mindset. It's not about I'm going to quit my job one day because I'm making so much money in the stock market. It's never going to be that. It's not rags to riches where you buy a little stock here and it turns you into a millionaire in a year. No. What you're learning is a decision-making process, strategy, risk management. How to investing is like shopping, right? You go down the different aisles, you select a few things here and there. You don't spend too much time. You don't do so much analysis before going shopping. What do? You have in your mind something you want to buy, and then you wait for the right moment. Maybe you're trying to buy a laptop. You might wait until Christmas because you know that you'll probably get it on sale. Then there might be everyday things that you just have to buy from the shops, like milk and eggs and bread. Investing is like shopping. The parallels are very strong. Here's some mistakes to avoid. Keep emergency cash. This goes without saying. Invest about 30 to 50% of savings. You don't go broke taking profit. Buy and hold, which is what you'll read in a lot of the books. It's that strategy is old. No one does it. It's old. It's not going to make you money. You don't go broke taking profit. If you made a very, very healthy profit, sell. Sell. There will be another opportunity. In fact, I'll show you the watch list in a minute, but the watch list I created has over 1,000 stocks and lots of opportunities. If you made money in Meta or Nvidia, you can sell those and find the next one. Don't start too small. And don't take £1,000 and then break it up into 50 different stocks. I saw so many people do this kind of stuff. Use good risk management. Don't buy all in one go. Invest in a personal trainer, a nutritionist for investing, i.e. myself. Hire me. These are just some good tips. Good risk management. I'll probably get asked, what is a good amount to start with? You start with what you can. But £500 is a good amount is like the what I'll say the bare minimum. And that will only get you one stock using the system that I teach. But one stock is better than none. It gets you skin in the game. Trends and watch list strategy. Conversation, awareness, jumping on calls like this, having conversation and just being aware of the world you live in, watching the news, being observant, will actually help you when it comes to your idea generation. Because the way SPA works is, and SPA is basically the acronym of Stock Pickers Academy. I call my clients Spartans. So if you see that terminology, that's what it is. Spartans have conversations. Spartans look around in the world they live in. They look at their hobbies. They look at their technology. You all work in, I'm going to assume you all work in tech. When you start seeing trends, you bring them to the table. We know how to create a watch list out of that. I set the price and I teach you a transaction strategy to execute on the price. This is what my watch list looks like. I built it myself in Google Sheets. There's buy alerts, sell alerts. And it's real time. I'll show you in a second. I've got a strategy that I teach. You will never, ever buy a stock unless one of these is filled out. So you'll always have a plan, and you would have done the scenarios. If the price drops, how much more you will spend, what your total budget is per stock. All of that gets done before you even buy the stock. That way, we take emotion out of the equation, we take luck out of the equation, and we just know that we will act according to our plans. Recommended books. These are my go-to for funds, ETFs, Effective Investing by Mark Dampier. For individual stocks, The Most Important Thing by Howard Marks. That's my mentor, Howard Marks. I don't think he knows he's my mentor, but he is my mentor. On Common Sense for the Thoughtful Investor. Endorsement from Warren Buffett, of course. Why I like this book, it has so much, literally what it says, on common sense for the thoughtful investor. For example, first level thinking versus second level thinking. So first level thinking says, Apple is a great company. I use their iPhones. They're going to be here forever. They got so much cash. Buy. Second level thinking says, hang on a second. Apple is a fantastic company, but maybe PayPal is better value for money. Maybe PayPal might actually has a better probability of making me money than Apple. Maybe Apple is at a bad price because investors have bought the stock, price has gone up, and maybe I have to wait for a dip. There's always that extra layer of decision making that you have to think. You don't need to be on this call to know that Amazon's a great company, but price ultimately is what will determine whether you make money or not whether a company is good or not. How you shop, value for money. And that's where I earn my money, because my skill set is being able to identify with decent probability what a good price is to begin the process of buying. So there's watching a stock and creating a watch list, and then there's actually buying and selling and knowing when to sell and knowing how to take your profits. This is the active stock picking side of things. The passive side, we know direct debits into S&P 500 averaging 10%. But this is the world of stock picking, and that's why I charge people to learn how to pick individual stocks, because the potential is just so much more than just sitting on index funds. But I can't despise index funds, because you've seen what index funds can do with compound interest. But wait till you see what stocks can do with compound interest. My personal average over the past 8 years is about 28%. It dropped from 40% as time goes on. I will be happy if it can average roughly 20%. That's still double index funds investing. So it makes sense. Here's some examples. If you follow my Instagram page, you'll see some examples. Beyond Meat, that's Hargreaves Lansdowne. This is what a deal ticket looks like when you buy. This was when I sold. Snapchat, one of my favorite stocks. If you look here, the end of 2018, it was about a price of 7. This stock went all the way up to 80. That's a 10 times return after lockdown, through lockdown. The alert. This is where it is today. Imagine that. All the way up to 80, all the way back to 11. You have to take your profits. And we were selling at 30, 50, 60, 80. Full disclosure, I bought Snapchat again at 10. Up until last week, it was at 17. I didn't, even though it's my favorite stock, I didn't buy it on the way down here. The right level was 10 for me and the strategy, just to let you know how cautious and careful I am. Why? And what has that done? It means that even though the price went up to 17 and back down to 11, which is a big drop, by the way, I'm still in profit. That's what buying at a good price does. It protects you. Someone else is probably buying at 50 or 40 and they're at a loss right now, not knowing what to do. You have to understand buying value for money and why community is so important to that process. Otherwise, just do index funds. Zoom, look at that, went all the way up to 260. Now it's at 95, 64 even. Meta, I love this stock. The SPA alert price was actually 100. It hit 100. A lot of people got in. Some people sold at 300. Some people sold at 400. And you can see you would have in what, the start of 2023 to now, 14 months, you could have tripled your money by buying shares in a company that you use that owns Instagram, WhatsApp, Facebook. Most of you, if not all of you, will have WhatsApp. And a lot of you would use Instagram. Now think about it. A company you're spending most of your time on, if you just learned how to invest a year ago, you'd have tripled your money on that stock. It's a $1 trillion company. Not going to be very volatile. Now it's paying a dividend. It's better than index funds. I'm telling you, picking stocks is better than index funds. But I have to start with the index funds message for some people who are just going to leave their money in the bank. So you understand that, listen, that's a starting point. You'll average your 10%, and it's even really powerful. 10% will turn 5K into 50K in 25 years. But what will individual stock picking do? You can do way more. And that's not to sell dreams. That's to let you know that you can even do both. My job as a coach is to open your eyes to all this stuff and to handhold you through that process and to stop you making bad decisions. Invisalign. I had clients who worked in the NHS. I had clients who were dentists. I said, what's going on? The SPA way is to ask them, what you seen in your workplace? You're a dentist. You might know nothing about stocks, but what trends are you seeing in your industry? Everyone is getting their teeth done. Okay, interesting. Any brands who makes Invisalign? Who owns Invisalign? Align Technology. Tech. Black women in tech. Hey, wonderful. AI. Dentistry. 200 was the alert price. It went all the way up to 700. In what? 18 months? Back down here. Second mil. That doesn't make you a day trader, by the way. It makes you somebody who knows when to exit a business. Because what you are as a shareholder is someone that owns a share of a business. Business does really well in a specific period of time where a lot of people were, at home, accelerating their journey into doing their teeth or beauty, skin, getting new interests. Interest rates went up. That killed a lot of valuations. So, of course, yeah, it makes sense to take your profit and wait. And it's only now that people are potentially thinking of getting back in. Bottom line is, you have to be in the room or you miss all these opportunities. And some of these opportunities, you're probably listening to me thinking, I do remember that there was a period of time where everyone's getting their teeth done. It's still happening. But if you're not in the conversation with people in a group chat, you're going to miss opportunities. And even if you do see opportunities, who's going to help you to strategize around it and make sure you're doing things the right way? I can tell you that Align Technology is a good company to buy now, and you've got 10,000 in the bank. You won't know how much you should be investing of 10,000 into a company that you like. I do. Not only do I know how much you should be investing, I know the prices. I know the budget you should set for this stock. If the price drops, what price you should add more at and why. That's strategy. Nvidia, look at that. 1,700 in 5 years. Which property is doing that? Which bank account is doing that? $1.8 trillion company. Look, you're not going to get the whole move, but you'll get reasonable chunks such that you average more than 20%. That's the aim. The aim is to your portfolio to average 20% a year. That's it. This one is doing 1,007. You see these winners here? This is the difference between I am happy and comfortable and targeting my portfolio to average 20%, but I'm of the knowledge that one or two of the stocks I may pick might really allow my portfolio to do 50%, 60%, 80%, 90%, 100%. I'm being very nice here. I'm very cautious on the numbers, but yeah, I've had a lot of beginners double their portfolios in 2 years, 1 year. Because ultimately, when you're seeing all of this and you're in the room, it helps. So that's the course. Before I get into it, I want to show you the watch list. This is it. This is the cash cow. These numbers here are real time. And it's not just a watch list, because a watch list is just like a list of stocks and the price. It's a screener. So there are other fields in here. There's charts. There's volatility. There's a bit of crypto at the top, Bitcoin, Litecoin, Ethereum. You can see the alert buy price for Bitcoin was 20,000. For Ethereum was 1,000. So it's doubled in a year. 150% you would have made on Bitcoin. So whilst the focus is on stocks, we cover everything, even a little bit of Forex. When the Liz Truss Kwesi Kwarteng thing happened, we were smiling to the bank. Why? Because we were converting 30%, 40%, 80%, 70% of our savings into dollars. January 2022. So it's not like we're predicting the price will drop. We just know the levels that make sense to convert a portion of our savings into dollars. It's about changing how we look at money. Property, stocks, currencies, diversifying the currencies you hold your savings in. So this is the real-time watch list. On the course, you will also get your own real-time, and it's in Google Sheets. Blotter. This is where you'll put in your trades. And you don't need to be good at Excel anyway. All you need to literally do is put in the ticker of the company you're buying, the price you're buying at, and it will automatically generate for you a default. What then happens is my clients will screenshot that, post it in my paid Telegram group. I might tweak it and say, instead of 15 buying your next one, make that 10 and make the last one 5, because I've looked at some extra charts. And then, yeah, no one buys anything without telling me, even if they've done my course. My course is £1,000. I price it the same way as learning to drive. And then you can also record transactions. So let's say you did buy Boohoo and you did buy 1,000 shares that cost £400 and you bought it at a price of 30. You put it in there. And if you're someone that's really busy, remember we said we'll buy more if it drops to 10. We'll sell if it gets to 50. If the price intraday was to drop to 10, you see that? Your sheet will alert. Or if it was to get to 50, your sheet will alert. So what that means is if you're someone that's busy, all you would need to do every day is a 1 minute check. And that's to open the sheet out as an app on your phone, because you can put it on your home screen. Is to just open the sheet out and just check that there's no yellow, i.e. there's no action for you to take, whether that's buying some more cheaper or selling for a profit. That's what my busy clients do. But I also make sure my busy clients don't select stocks that are very volatile, even if they are alerting. So the filter can hit buy alerts, and it will just show you the buy alerts. And I'm teaching you how to build a long-term investing portfolio using these buy alerts, but also to make sure you tailor the alerts to your own lifestyle. So there's some alerts you need to avoid because you're busy. There's some alerts you need to avoid because you might only be able to buy 3 stocks. So now I need to show you how to choose 3 alerts from 65. Okay. So that's in essence what it is. Obviously, follow me on Instagram, Stock Pickers Academy. I'll show you a bit about the course. Session 1 is just concepts. It's free, by the way. Session 1 is free, so you can all sign up and watch that session. You'll learn about my teaching style. It will cover a bit of what I've covered today, but it will do a bit more, way more, because it will teach you what a bond is, what a stock is, stocks versus bonds. Session 2, a bit of idea generation, what an ETF is. It will cover a bit of what I've done today, to be honest, session 2 and session 1, but we'll do a bit more. Session 3, we'll go through that watch list, explain to you all the columns, what they all mean, how I use it, and introduce to you the stock pickers investing process. Session 4, you'll learn how to actually construct a portfolio like this, and how to use this sheet properly, and how to select stocks, and how to monitor a portfolio. Session 5, due diligence, mergers, corporate actions, dividends, rights issues, stock splits, open offers, portfolio, how to rebalance your portfolio, how to use the virtual portfolio, financial statements, how to do a financial health check of a company, when to take profit, all of that. It's hosted on Thinkific, but I'm not going to go too much into this. I think you get the idea. I have a course. There are some testimonials. This is Hargreaves Lansdowne. This is what it looks like. Have different types of clients, high net worth, some with far less. We're all using the same process. We're all using the same watch list. People pay £20 a month to access this watch list. Some more testimonials here. 40% return. One of my clients in their portfolio. I think there were only 6 weeks in. And yeah, that's pretty much it. So I'm going to answer some questions now. I'm going to come back in and look at some of the questions and just answer them. But that should basically give you a summary, a basic summary of investing in the stock market. You've got your passive side, which I don't charge for. I think everyone should definitely be doing the S&P 500. You average your 10%. The only bit I charge for is to learn the strategy that I use to teach if you're picking individual stocks. Some people start with the passive and then eventually get to a point where they want to do a bit more, because by doing a passive and looking at individual stocks, sorry, by doing the passive, they get a feel of the stock market and they want a bit more. Some people go straight in with the stocks. Some people do a bit of both. But for me, I think the most important thing is the education, that you at least know that this stuff is possible. You understand compound interest and how to use that in the stock market. Even if you don't invest on the back of this call, even if you don't invest in stocks for 2-3 years, I think the most important thing is you know enough now to begin your journey whenever you feel ready. And you know someone that you can come and talk to, myself, if you ever have questions. So the Telegram group is free, so you can always ask any questions on investing in there. Sometimes I'll answer questions in my Instagram DM as well. But I think the key purpose of this call is, listen, the UK is it's not just in recession, we're in stagflation. Stagflation is when you've got inflation as well as a recession. It's quite a rare scenario. And when that happens, it can stay like that for a while. It's the worst. Growth is slow. And these are times where if you're in debt, you don't want to add to that. If you've got bad spending habits, this is a time where the economy will penalize you, it will punish you. You can get away with bad spending habits sometimes for a short period of time, but this is the environment now where money management is extremely essential. You can't afford to get it wrong. Doesn't mean you should all go away and invest, but you have to start thinking a lot more about your money. And that even includes in your careers as well, like just making sure you're making the right moves and get your income up. If you've got a business, also just making sure you've got the right community around you. But yeah, this is a time where money matters, money management, financial literacy has to be quite high. So I'm very happy that you're all on this call. Please connect with me on LinkedIn. You've got my name, because that's a career team as well on that side. There's a lot of people in SPA, a lot of celebrities, a lot of angel investors, a lot of people in tech and other careers transitioning over, teaching, yeah, name it. So yeah, definitely connect. Let me see if I can get some questions. Yes. And by the way, I intentionally only tend to leave a little bit of time for questions on these because I know that you can always contact me whenever for questions. But the most important thing for me was to get you that information and deliver as much value as I can so you've got something to take away. But if there are any questions that I don't get around to answering, just know that you can just send me a message on LinkedIn or Instagram and I will answer it there. So someone said money in index funds instead of a savings account. Absolutely. I mean, you can keep some emergency cash in a savings account, but you've seen index funds now. It's like a no-brainer. I know that generationally, maybe we didn't have grandparents or parents doing this stuff. So it's like there's a little bit of imposter syndrome. But look, that's why I'm here, right? There are people who have been doing this stuff. There are millionaires who literally have been on this. Their millions have become multiple millions and hundreds of millions, just literally passively doing this. So, and you can always. So yeah, my savings account is the stock market, picking individual stocks and index funds. I use a stock. Um, 30, you can always scale up, but 30 to 50% of savings invested in stocks is advisable. I recommend all of you also to, if you can, try and get life insurance and all this stuff, a financial advisor. I'm an investing coach. I'm not a financial advisor. Financial advisors are not allowed to educate you on individual stock picking, crypto, angel investing. I can. So I'm there to bridge that gap. But I also have a lot of financial advisors as clients because they're trying to learn as well. So financial advisors come to people like myself to learn as well. So I can also recommend financial advisors to you. If you're in debt, if you're struggling with budgeting or your credit rating, I've got also money coaches as well. I can give to you for that support. But I just focus on the investing side and mentoring, because investing is a team sport. I don't buy anything without telling my group and engaging in discussion, because my group has over 500 experts already from the city, managing money or working in research, accounting, and so on and so forth. How can we invest in low risk portfolio with a warranty of a minimum 10% return? Yeah, I think I answered that already. S&P 500 accumulated. But before you do that, don't go away and just do it. If you are going to do that, tell the group first. Hit me up in the Telegram group. It's a free group. I think sometimes we've got this tendency of to just take information, go and do it. Go away and do something. Always add that. Ask me the question. Tell me, oh, I was on your call. I'm now about to do it. Take me through your journey as well. There's a lot of value to that. So you don't go and buy the wrong ticker, or you go and buy the index fund that doesn't pay dividends, because they're different. There's still some nuance there. Just making sure you're on the right one. Don't just use information from this call. Come back to me, say, on the back of that call, I'm about to just do the passive side. The active isn't for me, so I'm not going to do your course. I just wanted to make sure that I'm doing things right. And I'll help you. When selecting ETFs, what dividend percentage range is ideal? Buying a stock because it's paying a dividend is like buying a car because it's got a nice sound system. I'll be honest, I don't really care too much about dividends. Yes, it's income, but I'd rather the share price goes up 20% than I get a dividend of 3%. Right? Very important, this point I'm making. There are a lot of books out there talking a lot of nonsense because they're written by people who are self-taught. They're not written, a lot of them are not written by people who have managed money professionally, institutionally. And a lot of them aren't written for people like you and me. They're written for people who are millionaires, who can get away with some bad investing habits because they've got cash in the bank. Very important points I'm making now. I've been in the industry, nearly 15 years now. No, I know I don't look it, but yeah, I've seen a lot of ups and downs. I've seen a lot of people with 20 years experience just blow out because they changed from the strategy. They wanted to do their own thing. They didn't really understand markets. I come from a place of privilege where I've worked in 4 different types of institution. Most people might do 10 years in investment banking. I spent 3 years in a hedge fund, 3 years in treasury, 3 years in a Jewish family office, and 3 years in an investment bank, the best in the world. So I was able to see 4 different ways of making money. That's why I teach a strategy, which you won't really find in books or YouTube. But I know it works because I've spoken to a lot. There's experts in my group currently working in. My old bosses in the group, okay? How much does he make every month from the stock market? Might have missed it in the beginning. So again, the stock market really isn't about making a monthly income to go and spend on holidays and stuff like this. The stock market is a way to grow your savings without needing to touch your savings. Mindset is so important that you get this bit right. So I average about 28%. Index funds will average you about 10%. But I've had years where I've done 200%. I've had years where I've done 0. I've had years where I've done 50%. I've had years where I've done 80%. But yeah, it took me, I think, 2.5 years before I made my first overall profit. And then it just went from there. Some of my clients have they've outperformed that. Their first year they were making 100% or 50%, 80%. The key thing is to get started, to have the education, to have the knowledge. The biggest beneficiaries of anything you learn from me are your kids, because they're going to start early. Their compounding will start when they're born. A lot of us are starting from like what, 30, 35, 25. So the younger you start, by the time you're 30, you've had 30 years of compounding. All of your children can potentially be millionaires by the time they're 30, 25. Just because even on the passive side with index funds. Looks like that's all the questions. Are there any more? Okay. So what I'll say to everyone is, please connect with me on LinkedIn. Definitely, because I do support people with their careers as well. Follow me on Instagram and support me. Support me, because there are not many people with my experience doing this. I'll tell you that for free. Like my post, comment, post a story. Invite your friends to join the free group. But yeah, definitely recommend, some of you in here, if you can, definitely buy the course. Okay, I see a few more questions. Can you open multiple ISA accounts? I answered that. You can, but you can't open multiple of the same type of questions of ISA accounts in the same tax year. How can we get the tool website you're using? I can't see the address. You can just type in compound interest calculator. There should be different ones on Google. Can you invest in the S&P 500 through your SIP pension? Absolutely. Yes, I do that. In fact, I do other funds as well, like clean energy ETFs, robotic ETFs. Yep, you can do it all in your pension as well. You should be if you do have a SIP. Is it a good time to invest now? Absolutely. Absolutely. Like I said, despite the world being so bad, that the stock market has hit a complete record high. It will continue to keep hitting more record highs. That's why we average 10%, because it does, even after dips, you buy the dips, it just keeps on going up. That's the S&P 500. So I'll leave it there for now. You know where to find me. Stock Pickers Academy on Instagram. And then link in the bio then has all my services and everything. But yeah, connect with me on LinkedIn and connect with me on Instagram. So even if you're not buying my services, you are at least absorbing bits of knowledge and nuggets that I post from time to time.